It has been recently reported that Warren Buffett's Berkshire Hathaway is sitting on a record pile of cash of about $128 billion. It was also reported that one of the leading longtime shareholders has dumped his position in Berkshire because, and I quote, thumb sucking has not cut the Heinz mustard during the great bull market. Although Berkshire has added to various stock positions, Buffett has continued to add to the massive cash hoard even as the Dow Jones Industrial Average and the S&P 500 continue to reach for record highs. Well, let's take a look. One reason Berkshire is still sitting on a mountain of cash may lie in this chart here, which is from Advisor Perspectives. If you remember, we've looked at this and similar charts several times. This chart is a variant of what Warren Buffett has described as the best single measure of where valuations stand at any given moment. As you can see, the ratio suggests valuations are at levels we've not experienced since the internet bubble nearly 2 decades ago. Some have said this chart shows that there's very little to the upside of the stock market and much more to the downside of the stock market. I'm going to refrain from stating my opinion and save that for another video, but surely only time will truly tell. And then there is this chart of the number of hours of work needed to buy the S&P 500. To be fair, the typical wage earner may not be heavily invested in the stock market, but the metric does give some perspective for how high the market has risen. But perhaps this chart also tells a story of how bad the employment situation is with regard to wage growth that seems to have stagnated for a very long time. So keep that in mind as a major factor when viewing the chart. Don't simply follow the talking heads and believe what they say is 100% correct, but take a good look at this chart because we may not refer to it again in the future. What I'm talking about is that with workers being replaced with robots and artificial intelligence, the hourly wage will no longer have the same meaning. In fact, it may already be an obsolete measure of the market. And as for the companies, without workers' wages, insurance, sick leave, etc., corporate profit margins may continue to improve, further pushing the stock market up. So can the stock market keep climbing the wall of worry regardless of the Buffett indicator? Very simply, yes. And we have just entered the new realm of quantitative easing that is not quantitative easing. On October 11th, 2019, the Federal Reserve announced it would begin buying Treasury bills to inject liquidity and stability into the overnight loan market and expand its balance sheet. The Fed's decision originated from the squeeze in the overnight repo market back in September. If you were not aware, the cost of borrowing cash overnight jumped to 6% from around 2%, indicating a liquidity shortfall in the overnight loan market. Because of a bunch of economic mumbo-jumbo speak, the Fed responded by injecting liquidity into the overnight lending market. This initial injection didn't settle the repo market, so the Fed then announced plans to purchase $60 billion per month in T-bills at least through the second quarter of 2020 and support for overnight repo operations at least through January of 2020. Apparently Warren Buffett may have to wait a bit longer before using all that cash for a corporate purchase, but he's been sitting on this pile of cash for some time, so don't hold your breath. And for today, that's ChewDog Charts. Thank you.